This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This chapter deals with groups. So, a group exists for tax purposes where one company is a subsidiary of another. Various rules and reliefs only applicable to members of certain group structures. So we're going to have lots of rules here. Now these rules, I have seen questions where they've asked you to write them out as to what is and what isn't. And also multiple choice questions. These are ideal for asking in multiple choice questions. So there are two types of group structure based on the level of shareholding ownership. So 51% groups and 75% groups. So 51% groups are more than 51% group companies that are all related. That's all you need for VAT registration, which you'll see in a later chapter. And there is the availability of AIA, but that's all you can get for a 51% group. And 51% groups also we've dealt with previously in the chapter. In chapter, I can't remember which one it is. The first chapter on corporation tax anyway. That's where you'll find the 51% issues. 75% groups, you can have loss relief and gains group membership. And there are lots of reliefs for that. Lots of conditions that go with that. So 51%, let's have a look at that one first. Definition. 51% group if one company is the subsidiary of another, and there are 51 subsidiaries, they are 51% subsidiary of another company. So for example, if I've got H Limited and we have A Limited and we have a 75% holding of that, B Limited 40, let's go for a 40% holding on that one. C Limited, let's go for 50% on that one. And let's go for D Limited and let's go for a 70% holding on that one. Okay. So 51% A, not B, not C, D. Okay, see how that works? Now, it also says where they are subsidiary of another company. So if we put here F Limited, and say we'd got a 95% holding, A had got a 95% holding in F Limited, then that would be 2, because 75% of 95% is 71%, and therefore that is more than 51%. Okay, I'll do that again. So it's a 51% group company if you have direct, these are direct. So we've got A and D. So there's 3 of them, 3 in that group for 51% at that point. Now, then we added in this one. If we add in F Limited, now A Limited owns 95% of F Limited. So the direct holding is 95%, but A is a subsidiary of H. So H's indirect holding of F Limited is 71% through A, and therefore that is also more than 51%, so it's actually a 4 group. Now control, it talks there about indirect or direct control of more than 50%. Dormant companies are excluded. Overseas companies need to be included. Okay, don't put dormants in. They are not trading. They are not part of this arrangement. Now, there are some implications for this. The major one is the profit limit that determines whether a company is large and is therefore required to make quarterly instalments. Chapter 16. If you haven't watched chapter 16 and been through the manual of chapter 16 yet, you need to stop this recording now and go back and do chapter 16. Each of the chapters in the manual is in a certain order because they progressively get more difficult, and the information in one chapter relates to the one afterwards. So please watch them in the right order. Now, if you have a group like we had here, where there are 4 of them, let's bring that down to here. So if we had 4, then you would divide that limit, no, not times, divide it by 4 in order to work out the limit to determine whether somebody needs to pay by installments. So I've given you kind of my idea of how that works, an example. Let's have a look at example number 1. A Limited owns 100% of the share capital of V, F and C. Now it has taxable profits of 400,000. So there are 4 of them in this group. Now does that mean that A Limited is going to have to pay instalment payments rather than paying 9 months and 1 day after the end of its financial year? Let's have a look at this. Is the wording. Now sometimes you may have to write a worded answer out rather than do numbers, but we've done it here because you can just see how it works. So there are 3 wholly owned subsidiaries, thus 4 related 51% group companies. You notice the technical terminology that's been put in this answer. If you could adopt that in your exam, that would be wonderful, because the examiner would think the student really knows what they're doing. Okay, now the profit limit, the revised profit limit, I like the use of this main term. So 3 wholly owned subsidiaries, 4 related 51% group companies, revised profit limit 375,000. Now A has TTP of 400,000 and will therefore be a large company. And if, as a large company, its previous accounting period, it should have made instalment payments for this period, quarterly payments. Okay, so that's the important thing, is using it for that purpose. Now, an AIA, only 1 per group of companies. You can allocate it however you like, doesn't really matter, but it must be up to the limit. Okay, you can choose to allocate it. Firstly, to reduce the profits of a large company like the one we've just seen, you could reduce that profits below the 375 limit, and therefore you wouldn't have to pay quarterly. So that would work. And don't forget the 130 special enhanced first year allowance on new equipment. Again, make sure you have watched the chapter on special enhanced equipment with the capital allowances that are available. Now, you're unlikely to get at this stage, I don't think I've ever seen a question whereby the AIA has had to be divided up and you've had to make a decision as to where to put it to reduce profits. So it's unlikely in a group situation to come up. Just be aware of it. So that's the 51% situation. What have we got here for a 75% group? Some more rules. Tax is made up of rules. Just to let you know, if you put all the rules in a book, and they are in books, they're either yellow and orange or red and green. If you put them all in books, the book pile is about that high, and the font, paper's lovely and thin, and it's about font size 4. That's how much you have to learn when you do your CTA exams. Okay, so we're learning probably about that much of this pile, about that much. Okay, well, you're doing really well so far, so let's keep learning these rules. Okay, definition of a 75% group. One company is a 75% subsidiary. It's gone up, hasn't it? And both companies are a 75% subsidiary of a third company. So that's a direct holding and an indirect holding. Both of them must be 75%. Okay, now the holding company must have 75% share capital, which means they're entitled to 75% of the assets on winding up and 75% of profits on distribution. Group relief is available in respect of current year trade losses, excessive qualifying donations, so where we'd had questions where the QCD had been wasted. Do you remember that one from before? Where we put them at the bottom of the calculation when we did losses. Those can be group relieved, and excessive property losses, they can also be relieved. Now, a condition. This is a condition. Such losses can only are only excess if they exceed the total profits of the company concerned before any other loss has been applied. Okay, chapter 18 will tell you about losses, and again, that is a chapter that you should have reviewed, done the examples of, watched the recording and of the lecture of before you come to this point. So, what about sub-subsidiaries? This is where you can get your tongue in a twist. Sub-subsidiaries. The holding company must have an effective interest in a sub-subsidiary for at least 25% for them to be in the same group for group relief purposes. We've got two examples here. If the parent company owns 90% of the shares in a subsidiary, which in turn owns 90% of its subsidiary, they're all in a group because the effective or indirect interest, indirect holding, is 81%, as you saw in the example that I gave you earlier. However, we've got one here. Subsidiary owns 80% shares in a subsidiary. Then the company, it's reduced. You see that's reduced down? Show your workings if you're going to deal with this. Show all the workings of how you've done the calculation with this. Okay, so example number 2. Let's have a look at this for a group structure. Are you ready for this? So Z owns 100% of A. So they must be in a group. Remember, holdings must be direct. So Z is definitely with A. Indirect. Both of them must be more than 75%. Now, A owns 80% of B. Therefore, Z's indirect holding of B is more than 75%. But if we go further down, because B owns 80% of C, that's not, because C's indirect holding is now only 64%. So Z is in a group with A and B. There are 3 of them in the group. But what's interesting here is B owns more than 75% of C. So we've got one group here which has got Z, A and B in it, and a second group here which is B and C. You can be in 2 groups. That is allowed. You are allowed to be in 2 groups. But you know we said about loss relief, that you can then move your losses around within the group and share them out, perhaps bring one of the companies below the limit so they don't pay by installments, that sort of thing. Now B can have losses from Z and A, but it must use them. It cannot then transfer them to C. B could have losses from C, but it must use them and cannot transfer them up to A or Z. So you can have, so it doesn't matter that it's in 2 groups, but you cannot then start manoeuvring losses between groups, if you understand what I'm trying to say. so you can be in more than one group. That's what's really important. Now, just a side note, if you get a limited company group question in your exam and it doesn't have a diagram, so in other words, it said Z owns 100% of A owns 100% of B, and B owns 180%, blah, and blah. You know what I mean? If you find it more difficult with the sentences, then draw it out. So it'll either be a direct one like this, or it could be like the one I did before. A, that one's B, that one's C, that one's D, and that one's maybe E, and that one's maybe F. Draw it out. The more complex it is, and drawing it out is fine. You will have scrap paper in your exam. I know it's a computerized exam, but if you're in an exam centre, you will have scrap paper. Draw it out so that you can visualize what everywhere is, because it's really important. This is quite a common question, particularly in multiple choice, but it could come up in a bigger question, in either a B or a section C question. And so once you've got the rules, direct and indirect 75%, and you can be more than one group. Include overseas, but don't include dormants. But draw it out if you're struggling with the words. I'm a visual learner, so sometimes if I draw things out, I can see them better than I can if it's in a sentence structure. Group loss relief. So trading losses may be surrendered to other companies in the group, which will then relieve them against their TTP. A member company may surrender its loss to any other member of the group. Okay, so the holding company to a subsidiary, subsidiary to a holding company, subsidiary to a fellow subsidiary, as we've already discussed. The surrendering company. So this is the person giving away the loss. Can surrender as much of its loss as it wants, and it's not necessary to relieve it against its own income first. We don't need it. We can give it away so that it would help somebody else within the group environment. The losses that can be surrendered. Current period trade loss. Those QCDs, this is a recap. Unrelieved property losses in the year. Losses, trade losses and property losses brought forward can be surrendered as group relief, but only to the extent that they cannot be set off against the surrendering company's own total profit first. So if you've got losses brought forward, you have to use them before you can give them away. Now that's not the same for current year losses and the property losses. You can give them away without having to use them first. Slightly different there. Now the claimant company, the person having the loss, okay, must use it in the same period as the surrendering company's loss-making period. You can't carry it forward. You can only utilise it. Now, important points to remember with regard to group relief. Losses can be group relieved to any 100% of a subsidiary's TTB, and 100% of a subsidiary's loss can be relieved. It's not restricted by the percentage holding. Okay. Any amount can be relieved. Okay, I think that's it for now. So let's look at example number 3.